How can the stock market be worth $50 trillion while nations drown in debt? How can the S&P 500 hit record highs as 60% of Americans live paycheck to paycheck? This isn't growth, it's theater. Wealth floats above a crumbling foundation. Corporations now valued higher than countries, digital assets exceeding the worth of all real goods, sustained by printed money and blind faith. This is not prosperity. This is an economic mirage. For decades, rising markets were seen as a sign of national strength, falling markets as crisis. That link no longer exists. Today, the market is detached from reality, an illusion built on speculation and artificial liquidity. Take Nvidia. In 2025, its market cap reached $4.4 trillion, larger than Japan's GDP, more than India, and surpassing the combined market value of all Swiss companies. A single chipmaker worth more than all U.S. farmland and nearly 15% of all gold ever mined. Absurd, but celebrated. This is not innovation triumphing, it's distortion. Valuations now reflect hallucination, not production or employment. The stock market is self-referential, driven by algorithms, leverage, and endless cheap money. The Magnificent 7 inches, Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, and Nvidia, hold $19 trillion in value, more than Germany, Japan, and India combined. Their rise isn't broad growth, it's capital concentration. A few companies consume the planet's financial oxygen. These numbers are warnings, not strength. Central banks have flooded markets with liquidity for years, turning capital into a speculative drug. Investors chase liquidity, not fundamentals. Price no longer signals value, it signals velocity. Charts rise not because of productivity, but because the printing press never stops. Money detached from meaning inflates digital assets while real economies flatline. The illusion of prosperity is the greatest deception of our time. This mirage is deliberate. Since 1971, after the collapse of Bretton Woods, money became a tool of control, untethered from gold. Post-2008, the distortion accelerated. Central banks unleashed trillions through quantitative easing and near-zero interest rates. These funds went to banks, corporations, and bonds, not the real economy. Early recipients benefited most, while ordinary citizens faced rising prices and stagnant wages. Two economies emerged. One of leveraged speculation, one struggling under debt. Corporations exploited cheap money. Instead of investing in factories, innovation, or jobs, they borrowed to buy back shares, shrinking supply and inflating prices. Between 2010 and 2024, U.S. firms spent $7 trillion on buybacks, more than Germany's GDP. Growth was engineered, not earned. Even debt-laden companies joined, supported by lenient central banks and complicit credit agencies. This is a new capitalism, resources dictated by access to cheap credit, survival by proximity to liquidity, not productivity. Genuine innovation became secondary. R&D stagnated while balance sheets swelled. Profits are engineered, health is cosmetic. The system now runs on illusion, a financial alchemy sustained by faith in endless intervention. The era of financial engineering turned global markets into theater, a performance to maintain faith in an economic system that no longer works. Motion was mistaken for progress, price for value, illusion for achievement. What began as crisis management has become a mechanism of control, rewarding manipulation over creation. The system that inflated corporate wealth also created a trap. Investors, institutions, even governments are locked in an invisible cage. Everyone knows the truth. Valuations are absurd, fundamentals are weak, but no one can step away without risking destruction. In a 2024 Bank of America survey, 91% of fund managers controlling nearly $500 billion in assets admitted U.S. equities were overvalued, yet they remained fully invested. Why? Because central banks have erased the concept of safety. When cash yields nothing, holding money becomes punishment. Markets are now the only oxygen in an economy starved of alternatives. This is not confidence, it is coerced participation. Pension funds, sovereign wealth funds, and individual investors alike must feed the machine to survive. Stop, and the illusion collapses. Continue, and the bubble expands. Interest rates, though higher than recent lows, remain historically low versus inflation. Bonds no longer yield real returns, savings erode in real time. Risk and reward no longer balance. Speculation has become survival. Markets no longer reward intelligence, they reward obedience. Algorithms trade billions in milliseconds, amplifying volatility and divorcing prices from reality. Financial models assume infinite liquidity, sustaining the illusion of perpetual growth. Temporary dips are instantly rescued by policy or intervention. Risk is socialized, gains are privatized. Even professional investors, aware of the fragility, cling to the system. Pension funds and institutional portfolios are tied to inflated equities. A 20% correction could wipe out trillions and spark global panic. The system cannot self-correct, it survives only through intervention. The illusion of prosperity has become dependency. Investors are no longer participants, they are hostages in a financial experiment with no exit. The longer it continues, the more devastating the collapse will be. Meanwhile, ordinary life suffers. The same liquidity that inflates assets suffocates the majority. Wealth multiplies for the few while essential costs rise for everyone else. This is not accidental inequality, it is engineered. The Canton effect is now lived reality. Those closest to money creation, banks, corporations, hedge funds, receive it first, expanding their wealth before inflation hits. By the time it reaches workers, essentials like food, housing, healthcare, and education have already become more expensive, while wages stagnate. The global middle class, once the backbone of democracy, is vanishing. Homeownership, once a path to security, has become a luxury. In the U.S., corporate landlords now own over 40% of new single-family homes in major metros. Families compete with institutions armed with unlimited credit. The younger generation faces the harshest prospects in modern history, trapped in debt, priced out of housing, paid stagnant wages, inheriting an economy designed to extract rather than empower. Upward mobility has been replaced by permanent precarity. This economic fracture is reshaping society and politics itself. As the gap between perception and reality widens, trust collapses. Populism rises not from ideology, but from despair. The stock market becomes a symbol of corruption, a scoreboard of inequality where gains are privatized and losses socialized. The system thrives on silence. As long as numbers rise on screens, the suffering below goes unseen. But distortions cannot last forever. Every artificial gain borrows from tomorrow's stability. The cost is not measured in points or percentages, it is measured in lost homes, broken trust, and the erosion of the middle class. Beneath record highs lies fragility, a market overextended, surviving only through perpetual intervention. Stability is dependence. Resilience is denial. Every quantitative easing, rate cut, and corporate bailout has weakened the economy's immune system. Risk has not disappeared, it has been buried, accumulating silently until a trigger, be it a rate hike, debt default, geopolitical shock, or financial collapse, sets off inevitable chaos. Global debt now exceeds $320 trillion, over 3 times world GDP. Every dollar of real output supports $3 of borrowed illusion. Small interest rises make corporations insolvent, governments fiscally strained, and over-leveraged consumers buckle. The modern market's supposed resilience is a myth sustained by monetary anesthesia. Central banks have become the market, buyers of last resort, liquidity providers, crisis managers. But their power is waning. Every stimulus buys less time. Every rate cut yields smaller gains. The system now demands infinite support for finite growth. Minor disruptions ripple globally. A single bank failure triggers continent-wide panic. An energy shock cascades through supply chains. Confidence evaporates faster than liquidity can replace it. The illusion of safety guarantees vulnerability. What lies ahead is not a normal correction, but a reckoning. Decades of artificial expansion must confront reality. The danger is not only the fall, it is the collapse of faith. When trust disappears, money ceases to function. Without trust, no market, government, or civilization can endure. This is no longer mere economic imbalance, it is a civilizational distortion. Value has become detached from meaning. Where once it was tied to production, innovation, and contribution, today it is defined solely by price. Stocks rise, not by what they create, but by how much they trade. Speculation is virtue. Labor is irrelevant. Central banks, once stabilizers, are now engines of distortion, guaranteeing liquidity at all costs, erasing risk, and severing effort from reward. The invisible hand has been replaced by an algorithmic one that prints value from nothing. The consequences extend beyond balance sheets. When money no longer represents real work, trust dissolves. Citizens lose faith in governments, institutions, and fairness itself. Inequality becomes existential. The system rewards access, not merit. Corporations measure success by stock performance. Governments chase GDP built on debt. Individuals learn to trade instead of build. Creation has been replaced by extraction. Civilizations face a fundamental question. What gives money meaning? When the answer is nothing, collapse follows, not through violence, but through loss of belief. The stock market's euphoria amid social decay is not a paradox. It is a symptom of a system that prizes illusion over reality. The next crash will not merely end a financial cycle. It will expose a civilization that forgot the purpose of value. Screens will glow with record highs even as the foundation rots. The system will celebrate illusion until belief itself becomes unsustainable. When that moment comes, the correction will be existential. The collapse will not destroy wealth, it will reveal what was never real. No algorithm can mask reality. No empire, currency, or market can survive what it denies. The stock market may soar above the world, but gravity is patient, and reality never forgets.